people who are involved in complex hedges in the silver market, I think are going to get massacred. I think they're in for some truly religious experiences, to the extent that a short position on silver that has been put in place by algorithms that are looking at silver markets over the last 40 years, those leverage guys are really truly in for a world of hurt. Long-term capital management worked until it didn't. It was a convergence trade. But the convergence trade wasn't set up for a third standard deviation anomaly. And I think the silver market is going to see a third standard deviation anomaly.
A growing sense of unease is emerging in financial circles as the structural fragility of the silver market becomes increasingly difficult to ignore. Although the aggregate short interest in silver, estimated at approximately $35 billion, may appear relatively modest within the global derivatives landscape, the real concern lies in the metal's market structure. Silver's shallow liquidity, outsized industrial demand, and historically suppressed pricing create conditions in which even a modest disruption could catalyze significant systemic repercussions. According to seasoned resource investor Rick Rule, such conditions represent more than just market volatility. They reflect a deeper fragility embedded in the architecture of modern financial markets, where confidence in pricing mechanisms and underlying collateral is deteriorating. Rule warns that in this fragile environment, any major counterparty failure linked to concentrated short positions could trigger a cascading reassessment of value across commodities and fiat-linked assets. Rule's broader concerns extend to the high-yield credit sector, particularly ETFs composed of junk-rated corporate bonds. While these instruments are marketed as highly liquid vehicles, their underlying assets are often deeply illiquid. If market sentiment were to shift sharply, as it did during the 2008 financial crisis, retail and institutional holders may rush for the exits, initiating redemptions that ETF managers would struggle to meet without incurring substantial losses. Rule explains that this structural mismatch between perceived liquidity and actual tradability has not been adequately priced into risk models, particularly at a time when inflation-adjusted yields remain suppressed and credit quality deteriorates. He notes that while silver may be the flashpoint, the broader implications could reach into multiple asset classes, exposing latent risks across the financial system. Drawing from his decades-long experience in distressed credit and commodity markets, Rick Rule highlights the precarious intersection of over-leveraged financial structures and a growing loss of trust in fiat currency regimes. He emphasizes that true risk lies not in the nominal size of any one position, but in the interconnectedness of illiquid debt markets. As valuation distortions continue to accumulate, Rule suggests that a repricing event, whether triggered by silver or other credit instruments, could signal the beginning of a broader realignment. This would not be a localized shock, but a systemic event, likely involving defaults, evaporating liquidity, and a recalibration of asset values across the board. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Let me answer that in parts. My experience has been that in precious metals bull markets, gold leads. And when gold's momentum attracts the generalist investor into the space, leadership transfers to silver. Whether we're there or not, I don't know. What I do know is you won't need to tell me when it occurred. They're usually pretty dramatic events. I've seen them happen 3 times before in my life. And you don't need a weatherman to tell you which way the wind blowing when that happens. As to a silver squeeze, I am not one of those who believes that there's been an ongoing conspiracy to depress the price of silver over time. I worked for great big financial institutions, and the idea that they would take a negative carry, a short position, over 10 years or 12 years, which affected quarterly cash bonuses, the probability of that occurring is nil. It wouldn't happen. Markets, all markets, are manipulated in the short term, and they're manipulated in whatever direction is easier to manipulate. For 40 years, you have manipulated silver markets down because that was their natural direction. I remember the 1970s when trading desks would manipulate the price of silver up because that was the easiest direction. The manipulation takes place because the futures markets, the paper markets, often trade 200 times the available silver to cover on a daily basis. They're much more liquid. So the game works like this. A short syndicate gets involved over the last 40 years short in the futures market. 6-year duration, 12-month duration, 24-month duration, that kind of thing. And they get what would be for you and I massively short. $2 billion short, $3 billion short, in a market where the nominal value of the positions is $400 billion. And then they borrow $50 or $60 million worth of bullion, and they pound it into the market physically at whatever point in time the market has the least volume.
Right.
And they use the impact of the physical market on the futures market to cover their shorts and pay off their physical loss. I mean, you see it happen time and time and time again. I don't think that there's any evidence that supports long-term price manipulation. I think that there's an aggregate of short-term price manipulations. The Eurobond market has been manipulated. The Euro market's been manipulated. The U.S. Treasury market's been manipulated. If you can manipulate markets that are that big, the silver market's a piece of cake. What'll change, Kerry, is that the easiest way to manipulate the market is going to go from down to up. People who are involved in complex hedges in the silver market, I think are going to get massacred. I think they're in for some truly religious experiences, to the extent that a short position on silver that has been put in place by algorithms that are looking at silver markets over the last 40 years, those leverage guys are really, truly in for a world of hurt. Long-term capital management worked until it didn't. It was a convergence trade, but the convergence trade wasn't set up for a third standard deviation anomaly. And I think the silver market is going to see a third standard deviation anomaly, which means that the people who are using silver as an unhedged corollary to some economic bet, and they're doing it from algorithms that are based on 40 years of trading history, they aren't prepared for a hiccup, and they're going to get a hiccup, to be honest with you. $35 billion is a lot to you and me, but the notional value of derivatives is more like $5 trillion. I'm not so concerned about that. I'm much more concerned about things like unfunded entitlement liabilities and the imbalance between the nominal and the real interest rates. I mean, if you want me to scare your audience, Kerry, I can really, truly do that. I'm less concerned about the impact on Wall Street and the derivatives markets by a silver short. I think it'll be, I think there's probably a couple of quantitative hedge funds that'll go broke. Good riddance.
No one cares about them anyway.
Yeah. But, the derivatives market is truly vast. There are other counterparty scenarios that scare me a lot more. If Moz and Paws in the United States that own high yield ETFs, junk bond ETFs, get a whiff of the beginnings of a credit crisis like they did in 2008 around real estate, and they go to sell those high yield ETFs, the ETFs are extremely liquid. They trade billions of dollars a day, but they're comprised of assets that are totally illiquid.
Yes.
If they redeem the ETF and the manager has to sell the bonds and can't, now that's a scenario that's truly scary. Kerry, in shows like yours, where there's live Q&A, I've talked to investors that held high-yield ETFs that didn't understand that the assets were comprised of junk bonds. They just looked at the cover yield, not how the yield was generated. When I was a younger man, I wasn't a young man, but in the 80s, I was pretty active in the high-yield credit market because I understand how to read bond covenants. And I remember that when Drexel Burnham started to blow apart and blew apart the junk bond market, we had a description for these illiquid bonds. We called them owl bonds. And we called them owl bonds because when you called your broker to sell, your broker would say, "To who? To who?"
I had some friends that worked at Drexel, and
Yep.
but then Leon Black picked over the carcasses of all those owls and made billions of dollars because, like you said, he could read a covenant.
It's a great, great, great market if you understand it. The oil and gas industry junk bonds in the 80s and the 90s made me, relative to my net worth, a large amount of money. I'm forever grateful. But I understood about oil and gas and I understood about covenants. I remember buying bonds with a cover yield of 12% that were selling at 60. I got a running yield of 20% and a yield to maturity of 35% in a debt instrument. Life doesn't get better than that, but that's not what's on offer today.
I remember making 20% on Ford bonds myself, right. But yeah. So talking about the junior resource sector.
If you ask AI to search the EDGAR database or the CDAR database for companies where general and administrative expense is less than 25% of total expenditures, that's a great use of AI. But if you ask AI to look for lifestyle companies without defining what a lifestyle company is, they'll go to CNBC or Kitco or places and they'll aggregate a whole bunch of narrative and misinformation. AI is really good for what the Bloomberg GoBots have been good for. It can search databases if you give it very, very, very specific correlations, and it can do it instantaneously. AI can do, in terms of comparative balance sheet analysis, if you know how to ask the question, tasks in 2 minutes that would take me 2 months, and I'm good at it. The important part, though, is that you have to understand how to ask it the right question.
The US dollar, long regarded as the bedrock of the global financial system, is now confronting significant headwinds as its purchasing power steadily erodes. Decades of expansive monetary policies and ballooning fiscal deficits have weakened confidence in the dollar's long-term viability. Persistently negative real interest rates and ongoing inflationary pressures have diminished its effectiveness as a store of value, prompting investors worldwide, including experts like Rick Rule, to increasingly seek refuge in alternative assets such as gold and other hard currencies. This shift reflects growing concerns about the dollar's ability to maintain stability amid an environment of excessive debt and monetary accommodation. At the core of these challenges lies an unprecedented global debt burden, which the Institute of International Finance estimates to exceed 350% of global GDP. This mounting debt has become unsustainable, necessitating ever greater monetary interventions to avert systemic collapse. Negative real interest rates, now prevalent in many developed economies, have distorted capital allocation by incentivizing speculative investments over productive economic growth. Rick Rule highlights how soaring asset prices have disproportionately benefited those already holding financial assets. The resulting structural imbalance underscores an urgent need for monetary reform to restore economic stability and address widening disparities before these pressures culminate in broader financial and societal disruption. Let's get back to the video.
Frankly, I'd buy more knowledge. I know that's not the right answer, but your best asset at age 30 is compounding your knowledge and working on your reputation. I suspect that what an investor might do, assuming they have no other assets, looking at the next 10 years, is to begin to save systematically and save probably half of what you save in gold. I say that not because gold will necessarily outperform other assets, but I think that over the next 10 years, the purchasing power of the US dollar will decline by 75%, and that gold will maintain at least its nominal purchasing power, which means that it is a high probability savings instrument. That's a boring answer. I'm tempted to say that a 30-year-old who believes that he or she will be able to increase their disposable income over 10 years, if they're looking at investments simply as investments, should consider buying ExxonMobil. I would agree with that completely. Knowledge is an asset. Well, you can lose it, but it can't be stolen. It can't be taxed. The fruits can be taxed. And your reputation, the same. What 30-year-olds need to focus on is the group of people they choose to be their community, because you become the sum of your friends. Your reputation, because if you lose it, it's very difficult to rebuild it. And your knowledge. All the risks that you face, Carrie, probably are manageable if you manage the risk that's to the left of your right ear and to the right of your left ear. Well, it's important to understand that the Green New Deal wasn't really about environment. Let's get that out of the way. And I also need to say I'm no particular fan of Trump. But I do note that he has been effective at rescinding executive decrees by prior administrations. And I have noticed myself a real change in the politics of the regulatory agencies. Which means frequently in the regulatory agencies, there was a belief at the staff level that resource projects should go ahead. But the politics of the agency were such, has really competent technical people working there.
Oh, yeah.
They've been hidden well for 20 years, but they're there. Now there is an incentive within the organization to get stuff done. They can use the knowledge that they have in the agency to complete the regulatory process in a responsible manner. It's further to what you say, Carrie. Mining, looked at empirically, is an efficient use of land. You generate an awful lot of economic activity and an awful lot of consumer utility by despoiling a very small piece of earth. The Resolution copper mine in Arizona, when it's built after 27 years of permitting, will have substantially less environmental disturbance than one golf course. Golf courses are green, and people like to play on them. So they're regarded as not being environmentally deleterious. But if you have a monoculture, which is to say grass, in a riparian area, the truth is that they're environmentally extremely dangerous. It's important to look at the concept of environmental degradation from an empirical, technical lens as opposed to an emotional and narrative lens. And I think what Mr. Trump has been able to do at the regulatory agencies is allow them to return to empirical rather than political or narrative analysis. What happens right now is that the risk is socialized. People promise to reclaim, but you know what a promise is worth, particularly for a bankrupt company. It's worth nothing. The best way to ensure environmental compliance would be for the company planning to do the mine to convince the insurance company to take the risk and pay them the price for the risk that they assumed. That lets the taxpayer off the hook. Then the regulatory process comes to be involved in prohibiting the discharge of deleterious materials from the mine site to the environment. Stop. That's what I'd like to see Mr. Trump do. That's not what he will do. What he will do will be to solicit campaign contributions and political favors from elements in society like the oil and gas industry that he thinks are more aligned with him than the other side, which is to say, Carrie, the old saw that Mencken had about elections being advanced auction of stolen property, refers to both Democrats and Republicans in equal measure.
Much has been made of the galloping price of gold over 2025 so far, and silver's trajectory is equally noteworthy. Looking ahead, gold's rise from just over $2,600 per ounce to a peak exceeding $3,500 by late April, signals strong momentum that is expected to be sustained, reflecting ongoing economic uncertainties and inflationary pressures. Meanwhile, silver's climb from just above $29 to nearly $40 per ounce, its highest level in 14 years, and its year-to-date increase of over 32% suggests that it is poised for continued gains, driven by both its monetary appeal and growing industrial demand. As market dynamics evolve, silver is likely to narrow its historic discount relative to gold, supported by tightening supply and expanding use cases in renewable energy and technology sectors. Consequently, precious metals are projected to maintain their critical role as essential hedges against inflation and currency devaluation, underpinning a robust outlook for both gold and silver in the coming years. Share your thoughts on Rick's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.